So what we're going to cover in this video is number one, how to do the DTI calculation. Number two, what are the maximum thresholds for approval on your DTI? And then three, we're going to go through some problem solving. There are times where maybe your debt to income ratio is just barely above that maximum limit, and we're going to walk through some ways that I take a look at that for problem solving. Number one, how do we do the calculation? It's pretty simple. We start with your monthly debts. We add in your new mortgage payment. So if you're looking to buy a home, one of the first things I always tell people to do is figure out, based on your budget, what you want to spend total per month on that mortgage. So monthly debts plus the total new mortgage payment, and we're going to divide that into your gross before tax monthly income. The result is your DTI number. So for example, let's say your monthly debts are $650. Let's say your target mortgage payment is $2,000. And let's say you've got $8,000 a month before tax income. $650 plus $2,000 divided into $8,000 equals 0.33, which we express as a percentage. Your DTI in this case would be 33%. Now, we need to talk a little bit about monthly debts because there are some things that are included in this number for our purposes, and there are some things that are not included in this. What is included is your credit card minimum payments, car loans, any installment loans, which would include student loans, any retained mortgages. So basically, if there's property that you own right now that you have a mortgage on it, you're going to want to include that mortgage payment in this monthly debt calculation. And then also any alimony or child support. The monthly debt number does not include your current rent, the utilities that you pay, your phone bill, your car insurance, your life insurance doesn't include that. And it also doesn't include your general lifestyle expenses. Now, we do need to drill down a little bit on one of these details, which is student loans. So student loans, if you are in a deferred status or a forbearance status, when I pull the credit report, a lot of the time it's going to show me a zero payment. Now, unfortunately, the mortgage agencies kind of got wise to the fact that loans were getting through with zero for the payments on the student loans, and they came up with a guideline. Anytime I see a zero monthly payment on a student loan where there is a balance, the general requirement is you're going to want to use 1% of the balance to count toward that monthly debt calculation. Now, there are some programs that allow a slightly different calculation. There are also some ways where if we obtain certain documentation that shows us what the payments are going to be, there are certain cases where we can use a lower number than that for qualifying purposes. But the safest way to do it is to take 1% of the balance and use that in that monthly debt calculation. Approval limits. This is going to be a big theme of all of these videos. I started wanting to do these educational videos because most of the information that I find on any of these subjects on the internet is wrong. Now, there are a bunch of personal finance sites that I like, and I'm not going to name them, but I've got a few examples of just totally wrong information about the subject of our video. I'm not going to name them. In most cases, lenders want total debts to account for 36% of your monthly income or less. Non-conventional mortgages, like FHA loans, may accept a higher DTI ratio, but conventional mortgages may not be as flexible. Not correct. A DTI of 43% is typically the highest ratio a borrower can have and still get qualified for a mortgage, but lenders generally seek ratios of no more than 36%. Finally, the specific numbers vary from lender to lender, but many lenders use 36% as a maximum debt-to-income ratio. That said, many other lenders will let you go up to 55%. Not true. So the first thing that they get wrong is what the DTI limits are actually set by. You saw in each three of those examples, they would have some language like, well, lender to lender, you may run into different numbers. Lenders don't set debt-to-income ratios. You can call 10 lenders in town, and they don't have different debt-to-income ratio limits, generally speaking. Where these DTI limits come from is actually from the mortgage agencies. So these are agencies like Fannie Mae, Freddie Mac, FHA, VA. They are the ones that actually set the thresholds. It's not really an individual lender-to-lender thing. The other thing that they get wrong, and I see this all over the place, a lot of the guidance that you'll find online assumes that mortgages are still, the guidelines are still, written in a book, and everything is manually underwritten. And this advice is basically, 30 plus years old. The 36% number, there's a reason you saw that in each one of them. And it's because that was the rule, like a really, really long time ago, back before we had automated underwriting. Now, automated underwriting is what we use right now. And not only is it what we use right now, but it's what we've used since 1994. And so the reason that you see that computer there is that is the computer image that came up when I Googled computer from 1994. That's to make a point. Automated underwriting has been with us for a very long time. What it is basically is the agencies that set these limits, they build an algorithm. That algorithm evaluates the overall strength of your loan application, and they compare it to what you're trying to do. They look at your credit. They look at the DTI, and they're going to set a limit based on your individual characteristics and the algorithm that's built into the automated underwriting system. So again, the AUS findings are going to tell you what your maximum approval limits are. The problem is there is not really a consumer-facing option to run an automated underwriting evaluation. So what I've come up with are some general limits based on my 15 years of experience. Now, these limits change from time to time. The algorithms are played around with all the time. We'll get an email that says, okay, Desktop Underwriter by Fannie Mae is coming out with a new algorithm basically, and here are the changes that we expect to see. So your mileage may vary with the numbers I'm about to give you, but what you'll see is that these numbers are very, very different than the 36% number that you see over and over and over again. And I'm separating them out into the different agencies that are involved. So on conventional loans, in general, where you start to run into trouble is at 45%. If your DTI is over 45%, you stand a strong chance of being denied. But in some cases, I have seen approvals go all the way up to 50%. On government loans, it's going to vary on the specific type of government program. So for instance, FHA, fairly routinely, I will see debt-to-income ratios of 50% approved, and in some cases all the way up to 57%. VA has a very wide range, from 41% to 60%. And USDA, this is a rural housing program, narrower range, 41 to 46%. Now, jumbo lenders, they are actually still a little bit old school in the way that they work. They do have us use an automated underwriting system to evaluate the file, but in general, they're going to set their debt-to-income ratios based on an actual published guideline that doesn't really vary from application to application. They're also much more conservative in general. If you're looking for a jumbo loan, you're going to have a limited set of options if your DTI exceeds 41%. There are some options, at least that I'm aware of, that will go up to 43%. Of course, some exceptions to that. You may find some lenders out there going higher, but generally speaking, 41 to 43% is going to be your limit. Okay, you've talked to a lender and they've said you have a DTI problem. I can't approve your loan because your DTI is too high. I wanted to create a little flow chart that walks you through how I would recommend evaluating this problem if you run into it. The first thing, I think my industry does not do a good job of this. You know, we see ourselves as being there to tell you what your mortgage options are, but I think a lot of us are very uncomfortable ever trying to tell anybody what to do. And I'm certainly not going to tell you what to do, but I will say, if your first impression when you run into a debt-to-income ratio problem is to say, well, darn it, I want to make this work no matter what, I really do think that you need to take it as a signal to stop, carefully consider your budget. The mortgage payment that you take on, I want my clients to not only be able to afford it, but to be able to comfortably afford it. Having a budget and having a really good sense of the number that is not going to make you uncomfortable. Knowing that owning a home presents, honestly, some additional expenses. I've never been one of those guys that says buy a house because it's cheaper than rent, because in my personal experience, it's not. There are all kinds of advantages, and in some cases, there are some financial advantages with owning a home. But in general, it's especially if it's your first time buying a home, you may be surprised by the amount of expenses that can pop up. You're fully responsible for the property. So there are bills pretty much around every corner that you could be facing. So I really do think it's important if you run into a DTI problem, first step, stop, consider your budget, and maybe adjust that target payment for your mortgage lower. The next option, you've got a lender telling you that he cannot approve you because of your DTI. Don't take any single loan officer's word for it. Not everybody is on their best day. They may look at your file and say, oh, The DTI is a little bit close to the line. I just don't want to hassle with it. No, I can't do your loan. Get a second opinion. Next up, like a lot of problems in life, you can throw money at it. Now, this presumes, of course, that you have money to throw at the problem. But one of the main things that we get around DTI limit problems is we have people pay off debt. So this works out particularly well if you've got a balance that's maybe a little bit on the low side and you've got a payment that's proportionally on the high side. You knock out that balance, you knock out that payment. And so therefore that payment is no longer in your overall debt to income ratio calculation. Next up, this may sound a little hokey, but I do recommend if you run into a DTI problem, you're thinking about buying a home. I've had many clients over the years that took my advice on this and got a good outcome. Your mileage may vary, but ask your boss for a raise. Make sure that, that your company is aware that you're looking to buy a home. And you know, see if there's an option there, because if you increase your income, then that makes your debt to income ratio better. So it's at least worth a shot if you're trying to go through some problems with your DTI. And then finally, the kind of option of last resort for most people, because most people do not want a cosigner, is you can add a cosigner. Now, the way a cosigner basically works is by adding them to the application, we add their income into the mix. But keep in mind, if we're adding their income into the mix, we've also got to add their debts. So that DTI calculation works out the same way, but now instead of just you, it's you and the cosigner together. So it's their income, your debt, their debt, plus the mortgage payment. And you run the calculation the same way. That is a good primer on DTI. I hope you found the information useful. Please do like the video and subscribe to the channel. I'm going to be doing a lot more of these educational videos in the future, and it would really be helpful to see my subscribers come up and for people to like the video so that I know that it's useful and that you're getting something out of it. Please do share this video if you know somebody that's maybe a first-time homebuyer looking to get their feet wet in some of the early exploratory stages of the process. Please send them the video. You can always call or text me at the number below. I would love to hear from you. Thank you very much.